Life insurance is one of the most important financial tools available, yet it remains one of the most misunderstood. At its core, life insurance is a contract between an individual and an insurance company. In exchange for regular premium payments, the insurer agrees to pay a death benefit to the policyholder's designated beneficiaries upon the policyholder's death. This financial safety net can help protect loved ones from financial hardship, covering expenses such as funeral costs, mortgage payments, outstanding debts, education costs, and general living expenses. Understanding life insurance, how it works, the different types, and how to choose the right policy can be essential to long-term financial planning and peace of mind. There are two primary categories of life insurance: term life and permanent life. Term life insurance provides coverage for a specified period, usually 10, 20, or 30 years. If the policyholder dies within that term, the insurer pays the death benefit to the named beneficiaries. Term policies are often favored for their simplicity and affordability. Because they don't build cash value and only pay out upon death within the term, premiums tend to be much lower compared to permanent life insurance. Term insurance is a popular choice for young families or individuals seeking to protect specific financial responsibilities, such as paying off a mortgage or funding children's education during the years when they are most financially vulnerable. Once the term expires, coverage ends, although some policies offer the option to renew or convert to permanent coverage. Permanent life insurance, on the other hand, provides lifelong coverage as long as premiums are paid. These policies not only pay a death benefit, but also accumulate cash value over time. There are several types of permanent life insurance, including whole life, universal life, variable life, and indexed universal life insurance. Each has its own unique features and benefits. Whole life insurance offers fixed premiums, guaranteed cash value accumulation, and a guaranteed death benefit. It is often used for estate planning or leaving a legacy, as it provides predictability and lifelong coverage. Universal life insurance offers more flexibility, allowing policyholders to adjust their premiums and death benefits within certain limits. Variable life and indexed universal life insurance provide investment options within the policy, enabling policyholders to grow the cash value based on market performance, though this also introduces more risk and complexity. One of the key advantages of permanent life insurance is its cash value component. As policyholders make premium payments, a portion is allocated to a savings or investment account that grows on a tax-deferred basis. Over time, the cash value can be accessed through policy loans or withdrawals, offering a source of emergency funds, supplemental retirement income, or even a way to pay premiums. However, any unpaid loans or withdrawals reduce the death benefit, and if the policy lapses with an outstanding loan, there may be tax consequences. While the cash value aspect can be appealing, it is essential to understand that permanent life insurance is generally more expensive and complex than term life insurance. Therefore, it may not be the right fit for everyone. Determining how much life insurance you need depends on your unique financial situation and goals. A common guideline is to purchase coverage equal to 10 to 15 times your annual income, but this rule of thumb may not be sufficient for everyone. A more accurate approach involves conducting a detailed needs analysis that considers existing debts, future expenses like college tuition, ongoing living costs for dependents, and any existing assets or other sources of income that would be available to your family. The goal is to ensure that your loved ones can maintain their standard of living and meet future financial obligations in your absence. It's also worth considering final expenses, such as funeral and burial costs, which can be a significant financial burden if unplanned. When purchasing life insurance, the cost of premiums will be influenced by several factors, including age, health, lifestyle, occupation, and the amount of coverage desired. Younger, healthier individuals will typically pay lower premiums because they pose less risk to the insurer. Lifestyle choices such as smoking, excessive drinking, or engaging in high-risk activities can lead to higher premiums. Some insurers also take into account your family medical history, driving record, and even your credit score when determining your rate. It's important to shop around and compare quotes from different providers, as underwriting guidelines and prices can vary significantly. The underwriting process often involves completing an application, answering questions about your medical and lifestyle history, and undergoing a medical exam. However, in recent years, the industry has evolved to include options for no exam or simplified issue policies, which may appeal to individuals seeking quicker approval or those with certain health concerns. These policies typically come with higher premiums and lower coverage amounts, but they offer greater accessibility. For people with serious health issues, guaranteed issue life insurance may be an option. These policies do not require a medical exam or health questions, but they come with higher costs and limited death benefits, often designed only to cover final expenses. Another critical decision when purchasing life insurance is choosing your beneficiaries. A beneficiary is the person or entity you name to receive the death benefit when you pass away. You can name one or multiple beneficiaries, and you can designate how the benefit is divided among them. Beneficiaries can include family members, friends, trusts, or charitable organizations. It's important to keep your beneficiary designations up to date, especially after major life events like marriage, divorce, the birth of a child, or the death of a previously named beneficiary. Failing to update your beneficiaries can lead to disputes or unintended distributions. Life insurance can also serve important roles beyond income replacement and debt protection. It can be a valuable estate planning tool, providing liquidity to pay estate taxes, equalizing inheritances among heirs, or funding buy-sell agreements in closely held businesses. In some cases, life insurance is used in charitable giving, with donors naming a nonprofit organization as the beneficiary or using the policy's cash value to support a cause they care about. Business owners often use life insurance to protect against the financial impact of losing a key employee or to fund business succession plans. As life circumstances change, it's essential to review your life insurance policy periodically. A policy that was appropriate when you were a newlywed might not offer enough protection once you have children or take on a mortgage. Likewise, as your financial responsibilities decrease, perhaps your children are grown or you've paid off significant debts, you may want to adjust your coverage or convert a term policy to permanent insurance. Some people find that maintaining life insurance into retirement is still beneficial, especially if they want to provide for a spouse, leave a legacy, or cover potential estate taxes. In conclusion, life insurance is a cornerstone of a solid financial plan. It offers the reassurance that your loved ones will be financially protected when you are no longer there to provide for them. Whether you choose term or permanent life insurance, the right policy can offer not just a death benefit, but also peace of mind, long-term financial security, and even living benefits depending on the structure of the policy. Choosing the right coverage requires thoughtful consideration of your current and future financial needs, your family's lifestyle, and your personal goals. By understanding how life insurance works, exploring your options, and regularly reviewing your policy, you can ensure that your coverage continues to serve as a powerful tool in safeguarding your family's financial future.